Palantir Technologies, a name that has become synonymous with innovation and cutting-edge technology in the world of data analytics. It's the company everyone's talking about, from tech enthusiasts to financial analysts and even government officials. This data analytics giant has been on a tear, revolutionizing how data is interpreted and utilized across various sectors. Its stock price has skyrocketed in recent years, reflecting the market's confidence in its potential and the value of its technology. Investors are excited about its cutting-edge technology, which promises to unlock new insights and efficiencies for businesses and governments alike. Palantir helps governments and businesses analyze complex data, turning vast amounts of information into actionable intelligence. They use it to make better decisions, streamline operations, and even predict future trends. This sounds great, right? But there's more to this story. While Palantir's technology is undeniably impressive, there are underlying concerns that cannot be ignored. Palantir's technology is impressive, no doubt. Their software can handle incredibly complex data sets and provide insights that were previously unimaginable. They've secured big contracts with government agencies, which speaks volumes about the trust and reliance placed on their technology. They're expanding into the commercial sector, aiming to bring their powerful data analytics tools to a broader range of industries. But their rapid growth has come at a cost. The company's aggressive expansion strategy has raised some eyebrows. Their stock price has risen faster than their earnings, leading to questions about the sustainability of their growth. This has led to a high valuation, which some analysts believe may not be justified by the company's current financial performance. Some investors are starting to worry. They fear that the stock's high valuation could lead to a significant correction if the company fails to meet the lofty expectations set by the market. Despite these concerns, Palantir continues to innovate and push the boundaries of what's possible with data analytics. The company's leadership remains confident in their vision and their ability to deliver long-term value to their shareholders. With ongoing investments in research and development, Palantir aims to stay ahead of the curve and maintain its competitive edge. As they continue to expand their global footprint, the company is focused on building strong partnerships and delivering innovative solutions to their clients. Palantir is also committed to giving back to the community, with various initiatives aimed at making a positive impact on society. Looking ahead, Palantir has ambitious goals and a clear roadmap for the future. They aim to revolutionize the way we understand and use data, making the world a more informed and efficient place. While there are challenges and uncertainties, the potential for growth and innovation keeps investors and analysts optimistic about Palantir's future. As this tech star continues to soar, all eyes will be on Palantir to see if they can live up to the hype and deliver on their promises. Here's the alarm bell. When billionaires start selling, it's time to pay attention. Big-time investors are selling Palantir stock. This isn't just a minor sell-off, it's a significant move that has caught the attention of the entire financial world. We're talking about billionaires who know a thing or two about making money. AQR Capital Management, Millennium Management, and other major players in the investment world are making moves. D. Shaw Investment Management. These are not small players. These firms have a history of making strategic decisions that often set the tone for the market. They've been dumping millions of shares. This isn't a decision made lightly, it's a calculated move based on extensive analysis and forecasting. This isn't just noise, people, it's a sign that something might be off. When you see such significant sell-offs, it's often a precursor to larger market shifts. These investors aren't just selling Palantir, they're diversifying their portfolios, which is a common strategy to mitigate risk. They're also buying something else. This is a classic move to balance potential losses with gains in other areas. And that something else is Arista Networks. Arista makes networking equipment. This company has been gaining traction and is seen as a more stable investment. It's a solid company with a more reasonable valuation. This tells you something. When seasoned investors shift their focus, it's often a signal to the rest of the market. These smart investors are rotating out of Palantir and into something they see as less risky. This move is not just about avoiding potential losses, but also about positioning themselves for future gains. They are looking at the long-term picture, and so should you. The market is always evolving, and staying ahead means making informed decisions based on the actions of those who have a proven track record. So keep an eye on these shifts, and consider what they might mean for your own investment strategy. Why are these billionaires selling Palantir? It's simple. Valuation. Palantir's stock price is very high compared to its earnings. This means investors are betting on huge future growth. But what if that growth doesn't materialize? That's the risk these billionaires are trying to avoid. Remember, these investors are not emotional. They look at the numbers, and the numbers say Palantir is priced for perfection. Any hiccup in their growth story could send the stock tumbling down. That's why these billionaires are taking profits now. They'd rather be safe than sorry. Let's talk valuation. Valuation is a critical aspect of investing, and understanding it can make or break your investment strategy. It's the process of determining the current worth of an asset or a company. Investors use various metrics and models to assess whether a stock is overvalued, undervalued, or fairly priced. Palantir is trading at a very high price-to-earnings ratio. This ratio, often abbreviated as PE, is a key indicator used by investors to gauge the relative value of a company's shares. A high PE ratio can suggest that a stock is overvalued, or it might indicate that investors are expecting high growth rates in the future. This means investors are paying a lot for each dollar of profit. Essentially, they are betting that the company's future earnings will be significantly higher than they are today. This can be a risky bet, especially if the company fails to meet growth expectations. Now, high-growth companies often have high valuations. This is because investors are willing to pay a premium for the potential of future growth. Companies in the tech sector like Palantir often fall into this category. They are seen as innovators and disruptors, capable of transforming industries and generating substantial profits down the line. But Palantir's valuation is particularly high. This has raised eyebrows among analysts and investors alike. Some believe that the company's unique position in the market justifies this high valuation, while others are more skeptical. Even if they meet their ambitious growth targets, it will take years for their earnings to justify their current stock price. This is a gamble. Investors are essentially placing a bet on the company's ability to deliver on its promises. If Palantir fails to achieve its growth targets, the stock price could plummet, leading to significant losses for investors. Investors are betting on Palantir's future, not its present. They are looking at the potential for the company to revolutionize data analytics and become a dominant player in the industry. This forward-looking approach can be rewarding, but it also comes with substantial risks. They're hoping the company will continue to grow at a rapid pace. Palantir has shown impressive growth so far, and its technology is highly regarded. However, sustaining this growth over the long term is a significant challenge. The company will need to continuously innovate and expand its market presence to meet investor expectations, but there's no guarantee of that. Competition is heating up. Other companies are also vying for a share of the lucrative data analytics market. This increased competition could put pressure on Palantir's margins and slow its growth. The economic outlook is uncertain. Factors such as global economic conditions, regulatory changes, and market sentiment can all impact Palantir's performance. In times of economic downturn, companies with high valuations are often hit the hardest. These factors could impact Palantir's growth trajectory. While the company has a lot of potential, it's important for investors to be aware of the risks involved. A high valuation can be a double-edged sword, offering the promise of high returns, but also the risk of significant losses. As always, thorough research and careful consideration are essential when making investment decisions. Section 5. Arista Networks, a more reasonable bet. Now let's look at Arista Networks. This company is not as flashy as Palantir. They make networking gear. Not exactly the sexiest business, but Arista is profitable. They have a strong track record of growth, and their valuation is much more reasonable than Palantir's. This is what attracts these billionaire investors. They see Arista as a safer bet. The company is already profitable, they're still growing, and their stock price is not as inflated as Palantir's. This makes Arista a more attractive investment in the current market environment. This brings us to a crucial point. Hype can be dangerous. Palantir has generated a lot of hype. Their technology is impressive and their story is compelling. But hype can inflate a company's valuation. This creates risks for investors. Value investing, on the other hand, is about finding undervalued companies. Companies that are trading below their intrinsic worth. Arista Networks, with its reasonable valuation and solid fundamentals, represents a value play in this market. So, what should you do with Palantir? If you're a long-term believer in the company, you might want to hold. But be prepared for volatility. The stock could easily pull back if they miss their earnings targets. If you're thinking about buying Palantir, think again. The risk-reward profile is not favorable at this valuation. You're essentially betting on perfection, and in the stock market, perfection is rare. This story reminds us of a crucial investing lesson. Don't chase the crowd. Just because everyone is buying a stock doesn't mean it's a good investment. In fact, it might be the opposite. When a stock gets too popular, its price can get ahead of its fundamentals. This creates a bubble that can burst at any time. Do your own research. Look at the company's financials, understand their business model, and most importantly, ask yourself, is the current stock price justified? If the answer is no, then stay away. There are plenty of other fish in the sea. Investing is a marathon, not a sprint. Don't get caught up in the hype. Look for companies with solid fundamentals, strong management teams, and a long runway for growth. These are the companies that will create wealth for you over the long term. And remember, there's no shame in taking profits. If a stock has gone up significantly, it's okay to sell some of your shares and lock in your gains. Don't be greedy. Greed is what gets investors